Our session is the first of two on discount rate determination. In this session, we focus on the capital asset pricing model and the weighted average cost of capital. We start with the company cost of capital and its relationship to the capital asset pricing model, the risk of the businesses in the company, and the weighted average cost of capital. Then we move to measuring beta and the cost of equity. And we conclude by introducing the project cost of capital. The company cost of capital is the return expected by investors in the firm's businesses. Therefore, it's the cost of funds invested in the firm's assets or businesses. Expected return and therefore the cost of funds depend on the average risk of the firm's businesses as measured by beta. Finally, the company cost of capital is the discount rate for the firm's average risk projects, or for projects with the same level of risk as the firm overall. This graph shows that the determination of the company cost of capital depends on the security market line and the risk of the firm as measured by beta. Suppose we have a firm with a beta of 0.96 and we have a security market line that starts with a risk-free rate of 4% and goes up with this slope. We read the company's cost of capital as that given by or associated with a beta of 0.96, and in this case the company's cost of capital is 10.7%. We'll spend a fair amount of time in this session seeing how this beta of 0.96 yields a company cost of capital of 10.7%. In doing so, we'll be using the capital asset pricing model, which, to review from last session, is equal to the risk-free rate plus beta times the market risk premium. As noted, company cost of capital depends on business risk. That is, the company cost of capital is based on the average beta of its businesses or assets. The average beta of assets is based on the percentage of the funds of the firm that are invested in each asset type. So let's take an example of a firm with three types of assets: assets in risky ventures, assets in moderate risk ventures, and assets in low risk investments. Let's say the firm has 1/3 of its money invested in each type of asset. And let's further say that the risky ventures have a beta of 1.4, that is higher than 1. The moderate risk businesses or assets have a beta of 0.96, and the low risk assets have a beta of 0.58. Given these numbers, the average beta of the assets of the firm will be 0.96. We're going to use this beta in the determination of the company cost of capital. Recall from an earlier session that the weighted average cost of capital is equal to the cost of debt, or the interest rate on debt, times the percentage of assets financed by debt, plus the cost of equity times the percentage of assets financed by equity. We could find the cost of equity with reference to the capital asset pricing model, where the required return on equity is equal to the risk-free rate plus the beta associated with the firm's equity times the market risk premium. Likewise, we can find the cost of debt with reference to the capital asset pricing model, where the required return on debt, or the interest rate paid on debt, is equal to the risk-free rate plus the beta associated with the firm's debt times the market risk premium. It's important to note that in calculating a weighted average cost of capital, These weights that come from the debt and equity financing ratios are based on market and not book values. Here we show graphically the relationship between beta and required return. First, note that the beta for the firm's assets is equal to the weighted average of the beta on the firm's debt and the beta on the firm's equity. This calculation of the asset beta as the weighted average of the debt beta and the equity beta is very similar to the calculation of the overall weighted average cost of capital as the average or the weighted average of the cost of debt and the cost of equity. As the graph indicates, we have a firm with a beta on debt of 0.3, which yields a required return on debt of 6.1%, a beta on assets of 0.96, which gives us our 10.7% return on assets, or required return on the firm as a whole, and a beta on equity of 1.4, which gives us a required return on equity in the firm of 13.8%. We're back to the Excel file that we've been using throughout the course. This worksheet is entitled Capital Asset Pricing Model and Weighted Average Cost of Capital. I've indicated up here some parameters that are associated with the security market line that was in the previous slide that we looked at. So let's say we have a risk-free rate of 4% and we have a market risk premium of 7%. So that the return on a diversified portfolio of stocks in the market would be 11%. Our hypothetical firm has a balance sheet characterized by, or described by, $4,000 in debt, $6,000 in equity, and $10,000 in assets. As indicated on the previous slide, the beta for debt is 0.3, the beta for equity is 1.4, and the beta for assets is 0.96. As a quick aside, note that the beta on equity is always going to be higher than the beta on debt because the investors in the firm's stock, that is the equity investors, bear significantly a higher risk than do the debt investors. This is a concept that we'll develop much more fully in the financing part of the course. Now, to get the required return on debt, equity, and assets, we're going to be using the capital asset pricing model. So what I've done here is to do a calculation using the capital asset pricing model to determine the interest rate on debt. Let me just kind of click it, double click it to show you the formula. The capital asset pricing model says that the required return is equal to the risk-free rate, and that's given by this B3 here, plus beta, which is in C7, times the market risk premium, which is in B4. So that calculation yields a cost of debt of 6.1%. I did the same calculation to determine the cost of equity. Once again, the cost of equity according to the capital asset pricing model is equal to the risk-free rate, 4% up here in cell B3, plus the beta on equity, which is 1.4 in cell C8, times the market risk premium of 7%, which is in cell B4. So we have our 13.8% required return on equity. We can get the overall R for the firm's assets, or for the firm as a whole, in two ways. The first one is to use the capital asset pricing model as we did for the R sub D and the R sub E. And once again, using the capital asset pricing model, the overall discount rate for the firm's assets is equal to the risk-free rate plus beta for assets times the market risk premium. The other way to calculate the company cost of capital, or the discount rate for the firm's assets, is to use the weighted average cost of capital formula, which I've done in this cell. So note that I've applied the weighted average cost of capital formula, which is equal to in D7, the interest rate on debt times the debt financing ratio, which is debt divided by assets, plus the required return on equity, which is our 13.8% in cell D8, times the percentage of assets financed by equity, which is equity over assets. Note that using the weighted average cost of capital calculation gives us the same overall company cost of capital as does using the capital asset pricing model. So to estimate the company cost of capital, we need to determine the cost of debt and the cost of equity. In practical terms, sometimes the cost of debt, or the interest rate paid to secure debt, is given by the debt markets. That is, you can go to the debt markets and determine the rate that you have to pay to borrow funds to support the firm or a particular project. The cost of equity is determined by the stock market. What's typically done is to perform regression analysis on stock market data to determine the beta for a particular firm and thereby to measure the cost of equity. The return on equity is given as the risk-free rate plus the beta on equity times the market risk premium. So the regression analysis puts data in that shows the market risk premium, includes the risk-free rate, and has historical information on the return on equity that the firm has paid. And then the estimate that comes out is just a slope coefficient, beta, for equity. These next few slides show the estimation of beta for several publicly traded firms. Here we have ExxonMobil for the period December 97 through April 2004. On the x-axis we have the market rate of return, and on the y-axis we have the rate of return on ExxonMobil. The data points indicate for each month in this time period the market return and the return for ExxonMobil. If we fit a line through these data using regression analysis, we get a slope that is equal to 0.51, indicating a beta over this time period for ExxonMobil of 0.51. So over this time period, ExxonMobil had actually a fairly low risk stock, or was a fairly low risk stock. Here's the same presentation for Dell Computer for the period May 91 to November 97. And you can see for Dell Computer that the beta is much higher. The line is much steeper. It has a slope of 1.87, indicating that an investment in Dell Computer stock over this time period had a much higher risk than did an investment in ExxonMobil over the period 97 to 2004. The next presentation is for Dell Computer, the period 97 to 2004. So it's a more recent period than the previous slide, and you can see that Dell Computer has become somewhat less risky in the last few years than it was in the earlier time period. That is, the beta has fallen down to 1.6. This next slide is for General Motors for the period May 91 to November 97. Now during that time period, General Motors was doing fairly well as contrasted with how it's been doing recently. And so we get, over that time period, a beta for investing in General Motors of 0.72. Somewhat less risky than an investment in Dell, somewhat more risky than an investment in ExxonMobil. But look what has happened to General Motors in more recent years. Plotting the data and fitting the line gives us a beta of 1.21 for General Motors in the period December 97 through April 2004. And I would expect that if we carried out this analysis for the years, let's say 2004 through 2007, we'd have an even higher beta. The key points are that the beta on a firm's investment depends on the relative risk of that investment. And for General Motors, the risk of return on investment has gone up over, let's say, the last several years, indicating that, or resulting in, a higher beta. And that higher beta will actually get converted into a higher cost of equity for investors in General Motors stock. Or, put another way, investors will, over the last few years, be requiring a higher expected rate of return on their investment than they would have required, let's say, through the middle of the 1990s. Now let's see how an equity beta is converted into a required return on equity or a cost of equity. Let's use a hypothetical example for General Motors based on the numbers that we just looked at. We're going to apply the capital asset pricing model. In the previous slide, we had a beta for equity in General Motors of 1.21. Let's say that over that time period, the risk-free rate was 3.3% and that the market risk premium was 8%. If we plug these numbers into the capital asset pricing model, we get a required return on equity for investing in General Motors of 13%. Now let's use this estimate of the cost of equity to determine the weighted average cost of capital for GM. Once again, this is a hypothetical example. Here's our weighted average cost of capital formula. We have a required return on equity or a cost of equity of 13%. Let's assume that the cost of debt for GM is 8%. Further, let's assume that GM is financed by 60% equity and 40% debt. Then the weighted average cost of capital calculation gives us a company cost of capital for GM in this time period of 11%. This 11% rate is the starting point for determining the discount rate for GM's evaluation of a new business opportunity. So let's use this 11% discount rate in evaluating a new business opportunity for GM. Let's say that GM is evaluating an investment in a new car division, which we'll call a green car division, because GM wants to get with the green movement and become more environmentally acceptable. I've entitled this worksheet Evaluation of Project Green by General Motors. It's a new venture evaluation, and first we're going to assume that this new venture carries the same risk as GM's current business lines. GM has an equity beta of 1.21, which corresponds to a return on equity of about 13%. It's got a debt beta of 0.588, which gives it a cost of debt of 8%. Now you can check my calculations for the cost of debt and the cost of equity just by looking at my formulas here. Given these debt and equity costs and the capital structure of GM that's represented here, we can calculate the overall company cost of capital for General Motors, which is about 11%. Now let's look at the cash flow analysis. I'm going to scoot down here. We have a 5-year period over which we're evaluating this new investment. In year 0, we have an initial investment of $300 million, and the project spins off or generates $100 million in positive cash flow for each of 5 years. So let's see how we got a $69 million net present value. I'm going to double click it so you can see my calculation and where the cells come from. First point is that the discount rate I used is in cell B10, which is our overall company cost of capital. Then I highlighted the cash flows for years 1 through 5 in the parentheses, closed the parentheses, and then went up and amended the net present value calculation by adding in the year 0 cash flow. And we get a net present value of over $69 million. So the net present value of GM's project is $69.7 million. Once again, just to review, the interpretation of this NPV is that this new Project Green for General Motors generates enough cash to pay debt at the 8% rate, to return equity at the required return on equity, which is about 13%, plus adding an additional $69.7 million to the wealth of the shareholders of General Motors. Before we end this session, I want to introduce the concept of the project cost of capital. When evaluating a new business opportunity, such as Project Green for General Motors, we have to think about the project risk in determining the appropriate cost of capital to use, or the appropriate discount rate. In selecting a project cost of capital, we typically start with the company cost of capital. And if, as we assumed initially for Project Green, the project has the same level of risk as the firm, then the company cost of capital is the correct discount rate to use in evaluating this new business opportunity. But if the project entails more or less risk, or higher levels or lower levels of risk than the firm's current lines of business, then we have to adjust the discount rate to reflect the higher or lower level of risk. So in the next session, we're going to be covering methods of adjusting for risk differences. Adjusting for risk differences amounts to determining a risk-adjusted discount rate.